90% of small account traders fail because they chase huge gains. They end up blowing their accounts by trying to double their money too quickly. Let me show you the fastest and safest way to grow a small account when trading common stocks. The 1% daily goal strategy. Aim to make 1% of your account each day through 2 or 3 well-planned trades. This should add up to at least 10% monthly when compounded, making it a realistic target for small accounts. I said 10%, not 20%, because let's be honest, you won't win every single day. But hitting a 10% gain in a month is achievable if you follow these rules. Many traders fail because they're chasing big wins from the start. They see a YouTuber showing off their rented car and believe they turned $100 into $500,000 in a few months. They fall into the trap of gambling. You're better than that. Instead of aiming for massive profits, break your daily target into 2 to 3 trades. Each trade only needs to bring in a small profit to reach your goal. For more information on how to become a profitable trader, check the links in the description below. This approach keeps your emotions in check and helps avoid the common mistake of overtrading. Start with a solid foundation. A steady 1% daily gain may seem small, but you'll be surprised at how quickly it adds up when compounded. Your small account can grow without taking unnecessary risks that might blow it up. The best part is that you don't have to catch every big market move. While others chase the next hot stock, you focus on finding small, repeatable patterns that consistently bring in modest profits. For more information on how to become a profitable trader, check the links in the description below. Use small position sizes if needed. There's no shame in starting small while you prove your strategy works. Your account size should not dictate how you trade. Whether you have $1,000 or $10,000, stick to the 1% profit rule. This keeps you safe as your account grows and prevents you from getting too confident with larger positions. The truth is, most traders struggle because they don't treat trading like a real business. They jump in and out of trades randomly, hoping to get lucky. But consistent profits come from having a plan. And once you hit your daily target, stop trading for the day. Many traders give back their gains by getting greedy. For more information on how to become a profitable trader, check the links in the description below. If you make your 1% target in a single trade, great. Pack it up and come back tomorrow. Lot scaling method. When you start, use minimal position sizes, but once your account grows by 20%, you can begin to increase your position size slightly. This gradual scaling matches your account growth with position size. With a small account, position sizing is crucial. Start with the smallest position size possible, typically minimal shares in stocks. This helps protect your capital as you build consistency. Instead of rushing to trade bigger positions, prove your strategy works with small trades. Once your account grows by 20%, you can scale up slightly. This means your risk stays proportional to your account size. You're not suddenly taking massive positions just because you've had a few good trades. For more information on how to become a profitable trader, check the links in the description below. Many traders make the mistake of increasing their position size too quickly after a winning streak. This often leads to wiping out previous gains with a couple of bad trades. Smart scaling helps avoid this pitfall. Keeping your risk consistent with your account growth, your strategy stays the same. Only your position size increases. The 2-to-1 profit target rule. Set profit targets at least twice the amount of risk on each trade. For example, if you're risking $50, aim for at least $100 in profit. This positive risk-to-reward ratio helps small accounts grow, even with a 40% win rate. For every dollar you risk, aim to make at least $2 in profit. This simple rule shifts the odds in your favor, even if you lose more trades than you win. Most traders get it wrong, grabbing tiny profits, but letting their losses grow too big. This is a surefire way to kill your small account quickly. For more information on how to become a profitable trader, check the links in the description below. The correct approach is to keep your losses small and let your profits run. The beauty of this strategy shows up when you experience losing streaks, and we all have them. You can lose more trades than you win and still make money. Day trading isn't about perfection, it's about giving yourself room to be wrong while still being profitable. Day trading isn't about perfection, it's about giving yourself room to be wrong while still being profitable. The three-strike rule: stop trading after 3 consecutive losses in one day. This preserves your capital and helps avoid emotional revenge trading after losing streaks. Day trading requires clear stopping points to protect both your money and your mental state. Many new traders fall into the trap of trying to win back their losses immediately, making bigger trades or taking riskier setups. But 3 losses in a row signals that something might be off, whether with the market, your strategy, or your mindset. The beauty of this rule is in preserving your capital. Instead of turning a bad morning into a terrible day, you protect your funds for tomorrow. Markets open every day. There's no need to force trades when things aren't working. Remember, small accounts can't afford large drawdowns, so have strict rules about when to stop. Stick to your plan and protect your capital from unnecessary losses. The break-even technique. When in profit, move your stop to break even once the trade reaches a 1-to-1 risk-to-reward ratio. This simple move protects your small account by ensuring you don't turn a winning trade into a losing one. Day trading requires you to shift your mindset from chasing profits to protecting what you've earned. Most traders burn their accounts because they focus too much on potential gains, but good traders focus first on protecting their capital. Once you've moved your stop to break even, you can let the trade run and see where the market takes you. But avoid moving to break even too quickly, as many traders make the mistake of doing this prematurely, only to be stopped out before the market moves in their favor. The half-size rule: trade at half your normal position size when testing new strategies or markets. Only increase size after 10 successful trades. This helps you avoid costly mistakes when trying new concepts. Half-position trades let you gain real market experience without risking too much. And don't rush to increase your size. Wait until you've completed at least 10 profitable trades before thinking about scaling up. For more information on how to become a profitable trader, check the links in the description below. The goal isn't to make money quickly, but to learn how your new strategy handles different market conditions. You might face fast markets, slow markets, and different volatility levels, and half position sizing ensures you stay protected throughout. The start of session rule: trade only the first 3 hours of the session when volatility and opportunities are highest. This prevents you from overtrading during slower periods. The first 3 hours of any market session are the best for active traders. Big players are setting up positions, creating opportunities for small account traders to catch strong moves. Most traders waste time sitting in front of the screen all day, but it's smarter to trade when the market is most active. Once the session slows down, trading becomes less reliable and more random. The range measurement rule: calculate the average daily range and take trades only within the first 70% of that range. This ensures you're trading when the market is making its biggest moves and prevents you from getting caught in late-day choppy markets. Markets follow predictable patterns. Most of the big moves happen in the early parts of the session before the market becomes choppy. Stay disciplined and trade within the 70% of the daily range for the best results. The time stop method: exit trades that haven't hit their profit target by the end of the day. This prevents you from getting stuck in non-moving positions. Time stops are critical, especially for small accounts, as they help keep your capital working. Close your trades before major economic news releases, as small accounts can't handle the volatility caused by news events. Always think of your trades like driving in extreme weather. You might be able to do it, but why take the risk? The higher time frame confirmation rule: only take trades that align with the daily trend. Trading in the direction of the larger trend is one of the smartest strategies for small account traders. Position sizing and risk management are essential for small accounts. Stick to the plan and protect your capital with a systematic approach. That's a wrap. I hope you found this video helpful. If so, like, subscribe. Thanks for watching. Until the next video, stay safe.